Texas commercial mortgage rates in August 2026 monthly lending update. And commercial real estate borrowers across Texas are navigating another period of interest rate volatility. So, whether you're purchasing an apartment complex in Houston, or refinancing an industrial property in Dallas, or acquiring a retail center in Austin, or buying a building for your own business, commercial mortgage rates can materially change the economics of a transaction. And right now, watching the Federal Reserve alone isn't enough. And commercial real estate investors and business owners need to pay attention to Treasury yields and lender spreads, and property performance and leverage and debt service coverage, and the increasingly significant differences between competing lenders. Let's make this simple. Here's what Texas borrowers should know in August of 26. The August interest rate environment. And the Federal Reserve maintained the federal funds target rate at 3.5 to 3.75 at its July meeting. Meanwhile, longer-term Treasury yields have recently moved higher, creating renewed pressure on commercial real estate borrowing costs. And that distinction matters. And many borrowers assume that commercial mortgage rates move directly lockstep with the Federal Reserve, when in reality, commercial loan pricing depends on the type of financing. So a bank might price a loan using Treasury yields or SOFR or prime or internal cost of funds index. And CMBS and institutional lenders may rely on Treasury benchmarks. And bridge loans are typically priced a spread above SOFR. And that means commercial mortgage rates can move even more when the Federal Reserve does nothing. So where are Texas commercial rates today? Well, there isn't one universal Texas commercial mortgage rate, and pricing varies considerably according to the property type and the loan amount and the loan to value ratio and your debt service coverage ratio, but also borrower strength, occupancy and property performance, the recourse requirements, the loan term and amortization, if it's a fixed versus a floating structure, but also the lender type. And as a current market reference, published Houston lending data in August has shown stabilized multifamily financing beginning in the upper 5 range, while broader conventional commercial real estate financing can move well into the 6% range and beyond. And higher leverage transitional and bridge transactions generally command significantly higher rates. Now, these figures should be viewed as market indicators rather than borrower quotes. And two properties with the same purchase price can receive materially different financing proposals. And we can have a conversation to get into the specifics. So why Treasury yields matter? And one of the most important numbers in commercial real estate investors should watch is the 10-year U.S. Treasury yield. And longer-term Treasury yields have recently moved upwards to the upper 4% range. When Treasury yields increase, fixed-rate commercial mortgage pricing can experience upward pressure, even without a Federal Reserve rate increase. So think of it this way. The benchmark rate plus the lender spread equals your approximate loan coupon. And if the benchmark rate rises 30 basis points while the lender spread remains unchanged, the borrower's rate is generally going to move 30 basis points higher. But there's another side to that equation. Competition among banks and credit unions and life companies and CMBS lenders and agencies and private lenders can compress spreads, and strong lender competition can partially offset some of the movements in the underlying benchmark. And this is one reason the borrowers should compare and complete loan structures rather than simply asking, hey, what's your rate today? So bank and credit union loans. Banks and credit unions remain an important source of capital for Texas commercial real estate. And they can be particularly competitive for stabilized properties with experienced borrowers and strong financial profiles. And some typical considerations include debt service coverage, LTV, the borrower's liquidity, the global cash flow, the property's occupancy, the guarantor's net worth, any deposit relationships, and the recourse structure. And one bank may decline a transaction that another lender aggressively pursues. And that's why understanding the lender's credit box can be just as important as understanding the interest rate. So SBA financing for owner-occupied commercial real estate. And business owners purchasing commercial properties should also evaluate SBA 7A and SBA 504 financing. And SBA financing could potentially provide higher leverage than conventional commercial loans, making it particularly useful for businesses that want to preserve their working capital. And some possible uses could include office buildings and medical and dental offices, and warehouses and manufacturing facilities and restaurants, automotive facilities, hotels, daycare facilities, and there's many other qualifying owner-occupied properties. And for many business owners, the strategic question isn't simply whether an SBA loan has the lowest nominal interest rate. The more important question may be, how much equity can the financing structure allow for the business to retain? And that's why SBA is great. Preserving capital for equipment and employees and inventory and expansion and working capital can sometimes outweigh a modest difference in the borrowing cost. Multifamily financing, and multifamily continues to benefit from one of the deepest lending markets in commercial real estate. And depending on the property and the borrower, financing may be available through banks and credit unions, but also Fannie Mae, Freddie Mac, HUD, CMBS lenders, life insurance companies, bridge lenders, and debt funds. And stabilized properties with strong occupancy and debt service coverage generally receive better pricing than transitional assets that are going to require significant renovations or lease up. And investors refinancing properties that were acquired during the low rate era should pay particularly attention to the debt service coverage. And a property can maintain the same NOI and still support substantially less debt when interest rates reset to a higher level. Bridge and transitional loans. And bridge financing remains an important tool for properties that don't yet qualify for permanent financing. And some examples can include value-add multifamily and lease-up properties and heavy renovation projects and properties with temporary occupancy problems, or acquisition or repositioning strategies, or transactions that just require fast execution. And bridge financing generally costs more than stabilized permanent debt would because the lender is assuming additional execution and property level risk. So the relevant question, therefore, isn't simply whether bridge financing is expensive. It's whether the bridge loan provides enough time and the right capital to execute your business plan to successfully refinance or sell the asset. So the number that investors really should watch is DSCR. And in today's lending environment, debt service coverage ratio, or DSCR, remains one of the most important underwriting metrics. And the basic formula there is DSCR is net operating income divided by your annual debt service. So say, for example, if a property generates $250,000 in NOI and the loan and principal payments total $200,000, 250 divided by 200 is 1.25 DSCR. In higher interest rates, we're going to increase your debt service. So that can reduce the maximum loan proceeds available even when the property's value hasn't changed significantly. And this is why some borrowers discover their refinancing challenge isn't LTV, it's the DSCR. So why shopping commercial loans matters more now. And commercial lending is highly fragmented, and banks and credit unions and agency lenders and CMBS lenders and debt funds and private lenders can evaluate the exact same property very differently. And a borrower might receive proposals with differences in interest rates and loan proceeds, in amortization and prepayment penalties and recourse options, and the closing costs and required reserves and covenants, or maybe interest-only periods and closing timelines. And the lowest advertised interest rate, therefore, isn't automatically the best commercial loan. The best financing structure is the one that's going to support the borrower's investment or business strategy. So what Texas borrowers should do now before applying. So before approaching lenders, commercial borrowers should assemble a strong financing package. So for investment properties, that typically includes current rent rolls and trailing operating statements, historical financials, property information, borrower financial statements, and a clear explanation of the transaction. And business owners may need additional business tax returns and interim financial statements, ownership information, projections, and management resumes. Better information makes easier underwriting, and easier underwriting can produce stronger lender competition. Should you wait for commercial mortgage rates to fall? Well, trying to perfectly time interest rates is a difficult concept, and a better question might be, does the transaction work at today's financing terms? And if the property generates adequate cash flow, the basis is attractive, and the financing is sustainable, and the investment fits your long-term strategy, waiting indefinitely for lower rates can increase its own, can have its own opportunity cost. Conversely, a deal that only works if rates fall substantially may carry more risk than the borrower realizes. And strong underwriting means evaluating today's economics but maintaining flexibility for tomorrow. So the bottom line is that the Texas commercial mortgage market remains active in August 26, but borrowers need to navigate a more complicated rate environment. And Treasury volatility is putting pressure on borrowing costs, while competition among lenders continues to create opportunities for well-structured transactions. And for investors and business owners, the strategy is pretty straightforward. Don't evaluate the interest rate in isolation, and evaluate the entire capital structure. And we can compare lenders and help you understand DSCR and protect your liquidity. And we'll help you evaluate prepayment provisions. And then structure the financing around your long-term investment or business objectives. My name is Bill Rapp. I'm with the CommLoan and Power program. And commercial real estate financing isn't a one-size-fits-all type deal. And the CommLoan platform helps commercial borrowers evaluate financing opportunities across a broad lender network and identify structures that are aligned with their transaction. So stay informed, borrow smarter, and we can invest stronger. Thank you for watching. That's it for the day. You can visit my website, billrapp.comloan.com. I appreciate your time. Take care.